So this is a previous year question. Color paint is a manufacturer of industrial dyes. It can produce and sell at its maximum capacity of 20,000 liter. The sale price is 100 per liter. The present sales are 15,000 liter. That means capacity utilization is 75%. Okay, balance is 25% is still available. So I'll also write units, 5,000 units or 5,000 liters in this case. The current cost structure is as follows. Direct material 30% of sales. So this means 30 per liter. Direct labor is 20% of sales. That means 20 per liter. Variable overhead 20 per liter. So this is directly given. Profit is 15 per liter. To produce over 20,000 liter and up to another 10,000 liter, some balancing equipment are to be installed at a cost of 10 lakh, and the same will have lifespan of 10 years. The present cost structure is estimated to go up due to price escalation as under. 10% in material, direct material from its present level of 30%. What is the meaning of this? From 30% it will go to 40%. No, from 30% it will go another 10%. Then 25% in direct labor from present level of 20%. That means plus 10% and plus 25%. 50,000 in fixed overhead per year. There is a proposal from customer to take 10,000 liter additionally over the present level of output on a long-term basis at a price of 90 per liter. Apart from this investment of 10 lakh, fixed overhead will go up by 50,000 due to additional administrative expense. The company is in a dilemma as to whether accept the order for 10,000 liter or to use the present capacity of 5,000 liter, for which there will be additional selling expense of 50,000 rupees. As a management accountant of the company, give your recommendation. Ignore financing charges. Very good. So first let us write the decision tree. So 20,000 liter. This is my capacity. What is the current scenario? I am producing 15,000 liter at 100 per liter sales, and along with this there is a contribution, there is a fixed cost, then you have a profit. So this is given. Second additional order 10,000 liter additional, but this is at 90. So should I accept? Because it has 10 lakh additional plus 50,000 additional fixed cost. Apart from this, what else I have? I have my balance 5,000 capacity, 5,000 liter. So if I go with this, again I can sell at 90 per liter, but I incur 50,000 extra fixed cost. So in all the cases I have to calculate using my statement of marginal cost. So let us first prepare for 15,000. So start with sales 100 per unit less variable cost. So what are my variable cost? Direct material 30, direct labor 20, variable overhead 20, and profit 15. Profit I leave it. So variable, direct material, direct labor, variable overhead 30, 20 and 20. Again I don't know whether there is going to be any other variable overhead, so I leave one blank here. Okay, so 30, 20, 20. So 70. 70 is my total variable cost. That means my contribution 30 into 15,000. So 4,50,000 is my total contribution. Then what are my fixed cost? So fixed cost I have to calculate because I know profit now. My profit per liter is 15 and I am producing 15,000 liter. So 15 into 15,000, 2,25,000. That means my fixed cost is the balancing figure. So this is also 2,25,000. So now I will calculate with escalation. My sales is currently at 100 only. Total 15,000. I'm still calculating with escalation because my direct material is going up by 10%. So 30 into 1.1. Okay, my variable direct material 33. And direct labor is going up by 25%. So 20 into 1.25, 25. and variable overhead is 20. So my new contribution is 78. Sorry, my new variable cost is 78, new contribution is 22. 22 into 15,000, I'm getting 3,30,000 as my total contribution, minus fixed cost is 2,25,000. So my profit is 1,05,000. Now I have a decision to make. Should I go with 10,000 additional or 5,000 additional? So both I will calculate. First I will calculate whether I should go with the additional 10,000 liter. So if I go with additional 10,000, what are my impacts? I will read this. To produce over 20,000 liter, some balancing equipment is required, 10 lakh, and have a lifespan of 10 years. So that means I will have a depreciation, additional fixed cost. Okay, so 10 lakh divided by 10 year, it is going to be 1 lakh per year. So this is one additional fixed cost. And also they are saying 50,000 in fixed overhead per year. This also will go up. So plus 50,000. So apart from, so this is regular increase in the fixed cost. Apart from this, the fixed overhead will go up by 50,000 due to additional administrative expenses plus another 50,000 rupees. So now I will add all of them into the cost sheet. So additional 10,000 liter, my selling price is restricted at 90 per liter. It is not 100. Then my variable cost is not changing. It is 78. So my contribution remaining is 12. So 12 into 10,000. 1,20,000 is my contribution from this additional order. But apart from this 2.25 lakh, how much I have to incur? So 1 lakh plus 50 plus 50. So 2 lakh extra. So I will incur 2 lakh extra. So I am ending up with minus 80,000 as profit. So I should not accept this. Then what else is my other option? My other option is additional 5,000 only. That means I am not incurring anything extra. It is within my capacity. So 90, then total variable cost is 78. My contribution is 12. 12,000 into 5,000. Sorry, 12 into 5,000. 60,000 is my new contribution. But I have to incur additional selling expense of 50,000. This is there. So additional 50,000. So I have a profit of 10,000 rupees. So that means this is acceptable. This is my decision. I will not go with that additional order. I reject that. But I can fulfill 5,000 liter if required at 90. In that case, I will end up with a profit of 10,000 rupees.